everyone. We are now going to discuss deal size versus risk aversion. And for this topic, I'm very happy to ask you to welcome on stage with me Toby COPPEL from Mosaic Ventures and Philippe BOTTERI from Accel Partners. So over the past 2 years, we have seen an increase in the size of the financing rounds. Some say that there has been a shift, that seed is a new Series A and pre-seed is a new seed. Philippe, this is something you've noticed as well. And how do you think that VC's expectations have changed?
Good. Well, I must say that it is something that I do have noticed. But I would say the world is divided in two today. I mean, you have the world of the haves and the world of the have-nots. And if you're in the have-nots, I would say the world remained the same, and you can still raise a Series A the same way you would have done it a few years ago. But now, if you're in the have and you have a startup which is getting some good momentum and get the interest of several VCs, I mean, that's where suddenly you're in the different category, and that's where you can see the size of the Series A would be twice what it would have been just a few years ago. So we do notice that change.
And in the early stage investment, I guess you've seen the same. From a company perspective, how do you think it impacts its business?
Sure. I mean, I think overall we've seen round sizes go up by 50 to 100% over the last few years, which means as an entrepreneur, it's great. You can raise 50% or twice as much money for hopefully the same amount of the dilution, and you can have more runway. So in theory, that's fantastic. I think what it does mean also is that you actually have to prove more on the seed money, which is good in the sense that you have more runway to be able to get to those proof points. But the challenge also is that the number of seed rounds that actually raise follow-on funding at Series A is probably only about 1 in 10. And partly that's because of the growth at seed stage. There's been an explosion of probably 4 to 5 times the number of deals at the seed stage. So there is a gap at Series A stage. That's what we at Mosaic were started to focus on. But it does mean as an entrepreneur, you have to really be able to demonstrate your models working at Series A to be able to raise successfully.
So it creates new opportunities for pre-seed funds and perhaps for business angels as well.
There's no question there's opportunities for all of those players, and in some cases it may make sense for a company even to raise a seed plus or a seed extension so that they can get to that point where they can demonstrate to a Series A round of 4 to 10 million euros that they have a model that's working, good product market fit. But I think entrepreneurs also need to be careful. It's so easy to start a company today. There's money growing on trees at the seed stage. There really is. And so we often we talk to entrepreneurs and make sure they really understand how hard it is and whether do they really want to go down that path. Just because the money's there, it doesn't mean that their business is actually a business that venture capitalists like us will be willing to fund when it gets to Series A stage. So it is a conundrum for people who are being offered a lot more money than they have. It's easier to get the money at seed stage, but it's also quite hard to raise the Series A and the Series B money after that.
Speaking about Series B or even Series C and C plus money, over the past 12 months, there have been some extra large rounds that have been raised. There was BlaBlaCar a year ago, Sigfox earlier this year, and HelloFresh, Delivery Hero in Germany. Philippe, does having so much money has an impact on the business and on the risk for the investors?
I mean, the question is, why do startups need so much money? I mean, I think if we look back at what happened, in the past, 5 to 7 years. I mean, you had the emergence of mobile, which has created global distribution channel that you can access really from the start. You have social, which gives you a way to connect with consumers in a way that was not possible before, and which can really accelerate your go-to-market. And then you have cloud technologies, which are enabling startups to build products much faster and at a lower cost. So what does this mean for startups? It means that suddenly the level of ambition has been raised considerably, and the ambition of the entrepreneur has been raised considerably. And therefore, now, when you were looking in the past at opening your market in a couple of countries, suddenly you say, wow, now we're talking about the world, and that's much bigger than 2 countries. I mean, even if you look at a company like BlaBlaCar, I mean, today, they operate in 20 countries, that's fantastic, but that's 2 billion people. There are 9 billion people in the world. So I would say they're just scratching the surface of what's possible. So in the front of so much ambition, you need capital to be able to realize it. Now, I would say that you have 2 types of business model. I mean, you have business model which are more asset light, where the money is a way for you to get to that next level of ambition. And then you have infrastructure project which required significant investments to get there. And you actually need that money to get to that ambition, otherwise it doesn't work. So that also makes a difference in terms of the risk of the project.
And it's probably also worth adding that not all of that money has gone into primary money into the company. A lot of those large rounds have gone into secondary purchases so to de-risk some of the founders so that they keep going, work harder than ever, even though they've already been on a journey for a while. So I think significant portions of those are it's important to realize that it's not just going into growing the business.
Thanks. So in terms of risk management, timing is of the essence. In an early stage company, when would you say that it makes sense to go international and to raise large capital rounds?
It's a great question. We love startups that are global from the outset, certainly in their mindset, the way they're thinking about their business, and the way they're architecting their team and the product from day one. Does it mean they have to launch in the App Store in 100 countries overnight? No, but I think to build and take advantage of the opportunities that Philippe was just talking about, you have to be ready and willing to go hard internationally when you can. Even Criteo, when I was an investor back in 2009, they were already operating in multiple countries from the very, very beginning, because the ad exchanges, the RTBs, you could access multiple countries easily, and the product was what was built with all those countries in mind. TransferWise, Tavid, who's just on stage here, is another one of my investments. I mean, at its DNA, it's an international payments product, so it was an international customer base from day one, and it was a peer-to-peer model. So, we love businesses that are inherently global to start with because they have appeal, and we don't think it makes sense to just say, well, let's prove it in one country and then we can prove it elsewhere, because it's almost as the same amount of work it is to get it working in France, as it is to get it working in 10 other countries. So, we're very ambitious when it comes to that, and we think that, we love to work with founders who sort of are willing to take that on. It's a lot harder, but we think the payoff is there.
But just if I can add to that, I mean, I would say, in my view today, we're in a world, for startups, which is extremely competitive. And the faster you can get the money, the faster you can scale, the faster you can beat your competition. So one way, and it's very tricky to understand when you're a founder, when is the right time to actually raise that money? When are the VCs going to be excited? When are they going to want to give me this $18 million for my Series A, right? And I would say that the way I would think about it is, investors like to know companies for a long time before investing. They like to build relationships. So keep in touch with these investors. Don't get them to ask them for their money. Just go and ask them for their advice. And then, maybe at some point, one of them is going to say, well, I'm happy to give you advice, but maybe I can also give you some money. And at that point, you know that the timing is right for you to raise that money.
And do you think these large financing rounds do also have an impact on the exit? Do you think that they could delay some IPO track or M&A opportunity? It may also have an impact on the valuation upon exit, right?
I mean, I think raising the money is much more about land grab. It's about you have a product that's working, there's good product market fit, and you can roll it out in multiple countries. You can also add new features to the product. So in today's world where, we're hyperlinked, hyperspeed, where entrepreneurs in China or in other parts of the world are seeing all these new businesses get started and then they're copying them. And so you need to be first. If your model's working, you need to be first. You need to be aggressive to actually deploy globally. If you have a lot of IP, it's obviously, that's not as important. But, so for example, Docker, we saw Solomon earlier. I mean, he's got a phenomenal product that I don't think anyone could have replicated, but there aren't as many companies like his that are being built. There are more companies that have business model innovation or service level innovation. So for those types of businesses, it's important once it's working to be able to go quickly and to raise the amounts of money. The exit will come when it comes, and we don't really focus a lot on that. As long as you're operating in a big market and you're in a segment that's broad enough appeal to lots of different buyers, then you'll figure that out at the right time.
Yeah, I mean, I don't think we're in the business of building company to sell them. I mean, we're in the business of investing in company who really truly want to achieve a vision. They want to change the world. They want to impact, tens of millions, hundreds of millions of people. I mean, that was the case for Facebook. It's the case for companies like Dropbox. It's the case for companies like BlaBlaCar, Showroom Privé. That's what we want to achieve. And we don't want to limit the level of ambition of our company by just saying, oh, no, you can't raise that $200 million because, that's going to limit your exit opportunity. We say, well, with $200 million, we can even go far, we can go bigger. Now this opens a new door, and that's what we want to achieve. And then if someone wants to buy them along the way, maybe at some point we'll say yes, but that's not what we're building the company.
I agree with you, but the VCs and the investors' expectations are getting higher. They put more money in the company, so they expect a higher return at some point.
I mean, of course you expect a higher return if you put more money in the company. But primarily you want to build a great company. That's what matters. And then if someone wants to buy them along the way, that's fine. But you're not optimizing just to sell the company for an exit. So personally, I'm not going to prevent a company to raise more money if I think that money is going to enable them to go to the next level. Because that's what we're for.
And I think it's about having option value. It doesn't mean you need to spend the money just because you raise the money. And the key question is how fast can you scale the team and the operations without it breaking the company? And I think that's something you can only figure out as you go. But having that cash in the bank certainly allows you to have that flexibility. It certainly keeps competitors on their toes in terms of their willingness to sort of to go after you aggressively. So I think if you're very confident in your business, raising larger amounts of capital, I think in today's markets, you can do it. And so as long as you don't spend it all, we certainly are in favor of it.
And do you think a company could be in a position where it will raise too much money?
For sure.
Could that impact adversely its position?
Well, look, I think it sets expectations of growth. And there are physical limits to how fast you can hire people onto your team of quality, how fast you can roll out new markets. And so you will run into that. There are laws of physics around that make it extremely challenging. And so I think
you can finish.
I think entrepreneurs have to just bear that in mind and figure out what's humanly possible. And I think a lot of entrepreneurs believe they're superhuman, so they can change the laws of physics, but generally they conform to some basic laws.
Thank you very much.
Thank you.
Both of you. So we will now welcome Marc Ménazé. Marc is a CEO and founder of Menlook. He also happens to be one of the first presidents of France Digitale. He was here since the inception of the association, and we are very happy to have him tonight.